Okay, I've got a treasure trove of numbers for you from Netflix because it was Q4 for them. So I've got Q4 and full year 24. I'll try and split them out where I can and let you know which ones I'm talking about. But we'll start off with Q4. Revenue came in at $10.2 billion. That was up 16%, but it'd have been 19%, Steve, if we were FX neutral. Gross profit about $4.5 billion, so 27% margin. 27% up. That's a margin of 44%. Net income came in at $1.9 billion. That's up 99%, a margin of 18%. And there was $1.5 billion of op cash flow, which was actually down 8%, and $1.4 billion of free cash flow, down 13%. In terms of full year 24 revenue, Steve, which we couldn't believe just off air how big Netflix has got. It's like a sleeper. 39 billion in revenue, up 16% year over year. 18 billion in gross profit. That's a margin of 46%. That was up 28%. Net income for the year of 8.7 billion, up 61%, and a margin of 22%. And then about 7.4 billion operating cash flow was up about 1%. Free cash flow 6.9 billion, which was pretty much flat. It's about 18% margin. In terms of business metrics, they're still giving us paid subs. Paid subs was 301.63 million, up 16%. About 18.91 net million ads in that full year. So if we want to break it down by geography, so UCAN was 4.5 billion. That was up 15%. Paid memberships for the year is about $89.63, which is up 12%, and quite impressive growth really for that area. In EMEA, revenue was 3.3 billion, up 18%. Paid memberships was about $101.13, up 14%. LATAM 1.2 billion, up 6%. Paid memberships 53.33, up about 16% again. And APAC was 1.2 billion. That was roughly flat. Paid memberships about 57.54. In terms of guide, they said they reckon full year rev will be 44.5 billion. That's about a 14% jump. That's actually a raise on their investor day. They said their EBIT margin will be about 29%. That was another raise. They reckon they generate about 8 billion in cash flow, free cash flow. That was about a 16% jump. They're going to spend about 18 billion on content in the year. And they reckon the first quarter, they'll probably end up with around 11% revenue growth, about 14% FX neutral. So they're confident on this growth continuing. I listened to the earnings call. I've picked out a few things from here, Steve, that will that hopefully interests people. But they attributed their strong Q4 performance to programs like Squid Game Season 2, the Jake Paul and Mike Tyson fight, the NFL that they had on, and the Carry On movie, I think it is. They all contributed significantly. And they said that was broad strength across content categories and regions. They weren't relying on any single title to sort of drive massive acquisition or massive engagement in the month. They reckon it was all areas contributing. The focus on 2025, they said, was to improve their core business, more series, more films, an enhanced product experience, and they want to continue to grow this ad business. They said that they're developing the newer initiatives, and these are things like live programming and also games. And they're going to leverage the returning hits. There's Squid Game, what they call in season 3, which I think is season 2.2. There's also Wednesday coming back for another season, which was a bit of a smash hit. And I think it's one of the last seasons of Stranger Things coming back. It might even be the last. So plenty to look forward to in 2025. In terms of guidance, they said that they'd raised the guidance, as I previously said, due to these improved fundamentals and also this strong Q4 24 performance. They're going to sustain healthy revenue growth, expand their operating margins, and continue to grow free cash flow. In terms of the live programming strategy, they're going to focus on can't miss special events. They've got the FIFA Women's World Cup this year, so you'll be able to watch that on Netflix. And they're also mindful of the bottom line and the challenges of hosting these big league sports, these full seasons and the economics involved in it. If you think about how much, Sky spend on the Premier League, Netflix is trying to be aware of just how much that you can rack up a bill by getting these things. In terms of the advertising business, Steve, do you remember when they said that wouldn't work? Ads now account for 55% of signups, and it's growing rapidly. rolling out their own first-party ad platform in more countries, and they reckon the runway for ad revenue growth is huge. They're still investing in gaming, in Netflix gaming, but they said that this is remaining small and disciplined whilst they figure out what it is exactly that they want to do with this department. In terms of pricing, there is some price increases coming in selected markets to reinvest in programming in those markets. And in terms of long-term growth, they reiterate what they always say. There's significant runway for growth as streaming expands, and they're just focusing on increasing their share of this sort of like long-term monetization. So a really impressive report, I thought, Steve. They was very confident on the call, and they had every right to be, given the figures that they've put out, to be this big and still growing at 16% or 19% FX neutral is really, really impressive. And yeah, I just think it went over $1,000, Steve. I don't know if you'd realised the share price had got that high. I sold this one a little bit too cheap, Steve.
My thinking on Netflix has changed quite a bit over the years that we've been on here. So my initial thought on it was that it looks quite risky because it's going to have quite high content spend and have to figure out, and that's going to be an ongoing content spend because it won't be able to get away with rerunning stuff forever. It will have to keep updating that library, so on and so forth. Somewhere along the line, Disney took back its kind of content, making that even more kind of tricky for Netflix. But I think the thing that is impressing me the most about this is, well, two separate things, I think, but they kind of go together. Number one is the unit economics on this, which is to say they keep adding subscribers, and at the state they're at now, adding subscribers costs them nearly nothing. And they increasing prices here means that they get both a combination of volume growth effectively in terms of sales plus price growth, which means it is having a huge effect on margins. They're kind of two big things that I've been paying attention to over the last couple of years have been clamping down on password sharing, which I always thought was a good idea, mostly because I don't see how you gain anything from people that are not paying. And ad-supported tier, which, yeah, some people may have thought this wouldn't work. I do say when I'm wrong, and when I remember being wrong about things, I was not one of them. I was pretty convinced this would work because I think people are used to seeing adverts on the telly in ways that they're not on Spotify and the radio. So some numbers that have been catching my eye on this. I've been looking at their revenue growth over year since 2018, and their revenue growth year over year had gone 35%, 28%, 24%, 19%, 6%, up to 7%, up to 16%. In other words, revenue growth is picking up. And while revenue growth is picking up, what you've seen is a fairly steady expansion in op margins, which has gone over the same period since 2018. 10%, 13%, 18%, 21%, 19%, 21%, 27%. And normally you would start wondering in this stage, look, that's getting to be quite a wide op margin, especially for this kind of business. How long until someone competes this away? I think it's very hard to compete away with where Netflix is at the moment. The bigger it gets, the more stuff it gets, the stronger it gets, the more difficult it becomes to compete with. The stuff like ventures into gaming, I'm not entirely sure what I think of them. Gaming isn't particularly something that I'm that confident calling trends or success in one way or another. I think they're more than entitled to have a look and see how it goes. It might be a kind of interesting option, but it's now reaching the kind of territory where it's got a few other things in terms of it can now start thinking about its kind of other bets, divisions. It's one of these businesses where I realize I'm seeing this kind of everyone pointing out a lot just at the moment, where its costs as they show up on its income statement are not always costs, right? Because so it spends a lot on content, even if that amount it spends on content probably as a percentage of revenues might be going the other way here, because its revenues are, as you see, starting to pick back up again in terms of growth rate as well, as it continues to make people pay for their own accounts and introduces ad-supported revenue, which is also nearly cost-free revenue and the like. But the more that kind of picks up, the more I think it gets further and further out ahead and more difficult to compete with. Things trading at 40-something times earnings I was seeing here, but look, 5 years ago, so it was now trading at 90-odd times earnings. might have been 10 years ago, it was trading at 90 times earnings. It has grown into that valuation. Basically, it didn't do it in a straight line. There was the time where it looked like things were going backwards in terms of memberships and subscriber numbers, and that was about the time that you bought it. And then it got back to looking like it was probably about right and going to have to do some work. And I think you probably got rid of it at that point when the margin of safety wasn't quite there. And since then, it's probably fair to say it has done that work pretty impressively, and it becomes quite hard to bet against it, Steve.
Yeah, exactly that. I mean, every time we had Paul on the show and he was talking about how the competition was coming for Netflix, I always used to say, "Well, I'm not particularly worried about that because they just have the best content, as far as I was aware." And I knew that obviously the others were looking to spend a lot of money, but Netflix's content for me was not only great, the speed that it was coming out and the speed that they were coming out with new shows that people seem to really like was really, really impressive. And yeah, just when it came down in price, it was just too cheap for me. I think it came down too far. And then when it started growing at 6 and 7%, I thought, look, there's probably better opportunity out there than 6 and 7%. I couldn't see a scenario in my head where it continued to grow in the double digits. And I think where I went wrong there as the lesson would be just looking at something like Spotify and seeing that their user numbers were much, much higher. And yes, they were at a lower price, but they were still growing quite strong. Even over that period of time. So, being able to see that number and applying it to Netflix and not particularly worrying about the price per se at that point was probably my lesson that I should have learned. But yeah, I thought there was better opportunity, and I still don't thinking out loud that I was particularly wrong about that. I mean, I wasn't anticipating a return to 16% growth, so I can't say I was right there. But what I wasn't factoring in was that the market would look at that, 6 to 16% growth or 7 to 16% growth, and then slap a 40 times margin on it, a 40 times multiple on it. I wasn't expecting that there would be multiple expansion of that kind of amount. I thought we were kind of out of the heady days, Steve. When I got rid of this, I was looking for a sort of 10 to 12% return, and I just didn't feel like I was going to get it out of Netflix. And I just tried to check them, but I couldn't get in time. But I would assume I've swapped a 10 to 12% return for 100 and odd percent return from where I sold Netflix. But I still did better than Bill Ackman. So I'll take that one, Steve.
I was just looking at the return over the last 12 months. I was just thinking to myself, actually, Netflix, of course, is a stock that used to be part of what we called the FANGs back when. So Facebook as was, Alphabet as was, Facebook as was, Amazon, Apple, Netflix, and Google, as it was kind of known. And that group sort of evolved to become Netflix out in Microsoft, Tesla, and Nvidia. Basically to make the now known as the Mag 7. And 1 year share price movements are not everything, right? There was always a decent case when we were talking about the FANGs that Microsoft was a sort of weird omission anyway. It realistically belonged in that category. It was kind of FANGs and Microsoft for a lot of people, which is perfectly reasonable thinking here. But over the last year, Netflix has roughly doubled. Microsoft and Apple have managed about 15% each in 12 months, which is not terribly impressive. Tesla's been there or thereabouts as well. Netflix. Nvidia's up 145%. Netflix is punching its weight amongst the category it used to be kind of mentioned in the same breath as here. And when they say there's a long way to go still for growth, I kind of believe them. I think it's very difficult to buy something after it's just gone up like that. But if someone told me they were going to, I don't think I could explain to them why I thought this was a bad idea in a way that they should stop.
Yeah, I agree with that, Steve. And I think obviously looking back as well, part of the reason that we probably didn't foresee this growth was because back then they were being asked about whether they were going to go into live sports or live TV, and they weren't really ever saying that they were going to do that. And they obviously had a bit of a sluggish start with the ad tier, and yeah, I just didn't foresee this kind of. I didn't foresee this kind of growth. I just looked through 463 was my sell, so it's a pretty stingy one. It is essentially half and a bit under where we are, but yeah, hats off to anybody who held on to it. To be fair, at the time when I said I was selling it, a lot of people were kind of like, "Yeah, me too." So I assume I'm in a big pool of investors who probably thought we'd. I think it'd gone from 14 times earnings to 20, 21 times earnings. And I think we were at a period there where we all had started to sort of consider the fact that perhaps this wasn't going to be valued at the 100 times earnings like it was. But it's definitely on its way there. And I agree with you, Steve. I think deservedly so. I think the long-term growth for this company has almost definitely returned. And again, with Netflix, it's always fairly easy to plot because they're gonna bring more and more content onto the platform, and it is that network effect, isn't it? People have got to be they've got to be on Netflix because it's got all the best content, and people being on Netflix allows Netflix to buy the best content. And you've got that little added bonus in the middle where Netflix every so often says, it's 20 quid now, it's 21 quid now, it's 22 quid now, it's 23 quid now. And they'll just keep pushing and pushing and pushing that. And obviously there are areas outside of that as well in we'll call it the developing parts of the world, the LATAM and parts of Asia, where, they're only just at the beginning of that sort of monetization. The ad tier will add, we'll sort of try and supplement some of the missing revenue there, but they're going to eventually start to charge more and more in those areas too. You can plot the growth if you're bullish. It'd be easy to plot the growth on where you think Netflix is going to go. But if you've got a bear case, I'd be keen to hear it in the comments if anybody's got one. But I think it's a fantastic business too.
Tough to build one. I'm also sticking by your thought, by the way, that I don't think we've ever been outright wrong on Netflix. We've correctly identified there are challenges ahead. They will have to spend on content. There are these challenges, those challenges at this price. Is the risk reward there? I'm okay with the idea of thinking the answer was no. If I went back and looked at it again, I'd probably still think something broadly similar about the kind of risks and rewards. But I also don't think I'm not minded to say this is a weird accident where Netflix has been lucky. They've been lucky maybe in a couple of ways, but they've put themselves in positions to be lucky. We've talked a little bit about how Reed Hastings has said, we don't know what the next big kind of hits are going to be. We make moves and it turns out that people really go for Squid Game, but there isn't no a kind of DNA written into Squid Game where we can say this is going to be a winner. Sometimes you get a better and worse idea, but there's an element of luck there, but Netflix has done everything right, putting itself in a position to be lucky. And look, it's not got to where it is now by kind of accident or weird hype or anything of that sort. It's been really, really good execution pretty much all the way. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.